Is the S&P 500 actually a diversified index? You might think that's a crazy question, but it is a debate that is occurring right now in financial and investing spaces. And in this video, I'm going to show you arguments on both sides of this debate. Now, when this argument starts, this is normally the headline. Someone who does not think that the S&P 500 is a diversified index will come out with a stat that looks something like this. And to be clear, this stat is correct. Right now, the S&P 500 is extremely top heavy. The top 10 names in the index make up nearly 40% of the entire index. So the argument goes, how can an index be diversified if 10 names make up nearly 40% and 490 other names make up just 60%? Now, on the surface, this argument has merit, but there are some immediate counterarguments that always come out. The first is, well, let's actually look at the performance makeup of the S&P 500 this year. So through the end of July, so July 31st, we are outperforming the average S&P return over the last 11 years. So the average is 8.9%, and we came in at 9.4%. Now, this has been a really great decade plus for equity returns. We've only had one negative year. By negative year, I mean negative through July 31st, and that was in 2022. And you can see from the table that 2026 is up in the upper half at 9.4%. And when you look at what's leading the charge here, right now I broke out the Mag 7 from the S&P 493, just because indices exist already and it's really easy to do it. Just to show you, let's take out some of the biggest names of the index, some of the names that make up that 40%, and see what the performance actually looks like. And so the counter argument generally starts with something like, well, sure, the index is top heavy, but look, it's the other names, S&P 493, that's actually leading the charge. So thus far in 2026, that is 100% accurate. The S&P 493 is greatly outperforming the Mag 7 index. It is up around 12.5%, and the Mag 7 is barely positive. So the counter argument starts, sure, it's top heavy, but every other stock is doing its job. And you see that when you also look at a similar chart, at least a similar idea, of the S&P 500 normally, which is cap weighted, versus the S&P 500 equal weight, where every single stock in the index carries an equal weight at the start of every month. And what you see is a similar story. So the equal weighted S&P 500 is outperforming the cap weighted S&P 500 in 2026. And following that up, market breadth has also soared over the last few months. So in March, this number hit near 40%, which has been its low for the year. And that is the percent of the S&P 500 that is currently above its 200-day moving average. So that number has gone from around 42% in March all the way up near 70% as of the recording of this video. So put these two arguments together, put these charts together as a response to someone who says, the top 10 names make up 40% of the S&P 500. How can it possibly be diversified? And you have a really good argument. The average stock in the S&P 500 is working again. But there is a counterargument to the counterargument. And it goes something along the lines of, sure, the S&P 500 is diversified by participation, but is it actually diversified by return? So let's look at what's actually driving the returns in 2026 in the S&P 500. So I'm going to show you by sector here. So this is the return contribution year to date by S&P sector. And as you can see, tech has driven nearly 2/3 of the S&P 500's return thus far in 2026. And if you increase that to the top three sectors, you have industrials at 14%, energy at 10.3%, And you're getting up close to 90% of the S&P 500's positive return has been driven by just those three sectors. Now, obviously, you have consumer staples and discretionary that are weighing it down, so the positive contributions are going to be above 100%. But regardless, this does not look like the return profile of a diversified index. And you go one layer deeper, so to add on to the counterargument, what do those three of the leading sectors have in common? They are all tightly related to the AI trade. Tech, almost self-explanatory, but you have the chip makers, or I should say semiconductors. You have the hyperscalers. A lot of the companies that are directly related to AI will sit in the technology basket. Then you have industrial names and energy names that are benefiting from the major CapEx spending or the AI infrastructure build out. So a lot of the names in these sectors are directly related to the AI trade. So again, let's start from the top. The S&P 500 is super top heavy. Top 10 names make up nearly 40%. The average stock is performing really, really well. Mag 7, some of the biggest names in the index, not really performing. The S&P 493 performing really, really well. Market breadth is up. Equal weight is outperforming cap weight. Then the counterargument to the counterargument. Tech is driving all of the returns. The top three sectors are all heavily related to the AI trade. And so what does that sum up to? Right now, we have broad participation versus return concentration. And so the big question that you need to ask when you're thinking about this question itself is, if things go awry in the AI trade, when stuff eventually maybe hits the fan, will the broad participation part of the index, the fact that the S&P 493 is outperforming the Mag 7, will that protect you as an investor against the return concentration that's being driven specifically by the AI trade? Now, I recently made a video. It's one of the more popular videos on this channel to date, that cracks are forming in the AI trade. There were four main reasons for that. I'll have the video pop up in one of the corners right now. So if you want to watch that video, again, it's one of our most popular. I put those four reasons in the bottom right as a little bit of a spoiler. I do go in depth in the video. But as you can see, even the names that aren't fully performing, so some of the bigger names, are directly tied in to the AI trade. So here, similar table to what you saw on the first slide, except I added the AI relationship of some of these names. Again, NVIDIA sells the GPUs. Apple, you might say it's a stretch to include them, as they specifically are not participating directly. But to me, that is almost participation. A massive tech company, a massive consumer device company of Apple size, sort of sitting out to the CapEx AI wars, almost makes it a part of the trade itself. The only two real non-holdouts here are Berkshire Hathaway at number 9 and then Eli Lilly at number 10. And again, so if the top 10 names make up 40% of the index, think about this. This does not include names, larger names, that are directly tied into the AI trade as well. AMD, Micron, Oracle, Intel, Lam Research, a lot of the energy and industrial companies that are performed really, really well recently. So a huge portion of the index, some estimate this number at 60 to 70% of the S&P 500 is directly tied in to the AI trade. So again, I ask the question, will broad participation, the average stock in the S&P 500 is working again, will that offer enough protection against the return concentration we're seeing from the AI trade? And that question is what I'm going to leave you with today. There are really great arguments on both sides of this debate. I just wanted to sum it up for you guys. If you enjoyed this video, if you learned something new, it would be awesome if you could take a second to subscribe to the channel. I greatly appreciate your support, and I will see you back here next Monday for another Macro Monday video. Have a great week, everyone.